mortgage-backed securities. Tell us what's going on with the mortgage-backed securities market.
So, mortgage-backed securities. We're going to get a 2008 replay. Yes, as if we didn't have enough problems already. Only it's going to be a little bit different this time in how it's structured. And good news, it's not a prediction because it's already happened.
Hello, everybody. It is Rob Keents, your host from Gold Silver Pros, and I am back with a returning guest. It's Kirian Van Hest, who goes by Deso Games on Twitch and on Twitter. How you doing today, Kirian?
Doing well. How are you?
Doing very well. Wanted to have you on because I think more than anybody, you see data in a way that's very constructive in terms of what's going on in the world. And you put a lot of this out over Twitter. You've done it in your articles. And I find a lot of it very enlightening and actually saves me a bunch of time doing all this work myself. So I wanted to thank you for doing it. One of the tweets that got me interested, you're talking about mortgage-backed securities. Tell us what's going on with the mortgage-backed securities market.
Yes, well, first of all, I like coming on the show as well because it allows me to nerd out a little bit. I mean, I enjoy all channels I get interviewed on, but we always get technical, and I got to say that does hit a special note. So, mortgage-backed securities. We're going to get a 2008 replay. Yes, as if we didn't have enough problems already. Only it's going to be a little bit different this time in how it's structured. And good news, it's not a prediction because it's already happened. I did a video about it in March of 2021 with the early stage investor. And basically the stuff that I was warning about back then has happened. And MBB, and mortgage-backed security ETF, has crashed to a new all-time low, faster than it's ever done before. So let me get into the screen share. I'm going to move you over to the side here on my second monitor. And we'll first look at the culprit, which is the 30-year bond. We are now a few months after the video that we did before about the US 3-month and the interest rates ignoring the Fed. Well, I think I'm right. So the 30-year has interest, the interest rate on the 30-year has exploded. And when you're talking about loans and credit and all of that within a nation, then it's all based on the relative government security of near equal duration. So you're talking about a 30-year fixed mortgage. The 30-year U.S. Treasury is the bond to look at. It's basically the way banks make money. They loan you money for like 4.5%, and then they deposit it in treasuries or something like that, and they make money on the spread. I'm not an expert on bonds, but I know enough to, well, basically predict a chart going down when it's staring me in the face. So in aggregates, according to Jim Bianco on Twitter, global bonds have lost about 10% of their more than 10% of their value in the past quarter. About $6.8 trillion in value has evaporated. Worst quarter in bonds in history, as far as we know. You have to go back a very long time to find another start of the year that was as bad as this. So what is happening now is unprecedented. And that's got to affect something. Now, let me pull up another tab that I forgot to pull up. When you hear mortgage rates going up because of the bonds, usually you hear a national average quoted. That is not all mortgages. That is simply the average of all credit ratings. And when you hear AAA mortgage, you hear the 760 to 850 FICO score. You would think that's the best of the best, right? AAA. When you look at the low to low subprime, you can see there's a 1.5% point of difference. And the 6.2% on your mortgage is already quite high compared where we were 6 months ago. So what this interest rate rise is going to cause is that a lot less people can afford to buy a house. Because when you see house prices rise, you don't see people getting more rich, you're seeing debt increase. Simply put, it's the same with any asset. You don't make a profit until you sell it. And if you want to sell a house, somebody has to buy a house, and you don't buy a house, you buy a mortgage. Hence, that debt goes up when housing prices goes up. So when then the interest rate goes up, that mortgage, your monthly payments get a lot more expensive, and you can literally see the difference here. And when the interest rates are going up because of general inflation, like it's happening now, it's not just mortgage rates that go up, it's all payments that go up. You have to pay more for food, you have to pay more for gas, you have to pay more for, I don't know, childcare, because the person working in the childcare is demanding more wage because they also have to pay for food. So in aggregate, that means that housing demand will fall, and in turn, that makes the housing bonds less attractive, or worthless, especially if you have a fixed rate mortgage at 4%, and currently a new mortgage is at much higher percent. So that mortgage bond is simply worth more. I'm sure that you, me, and everyone watching this channel on Twitter and such has been salivating over the thought that inflation is going to take care of your fixed rate mortgage, right? Like we've all been waiting for it. But that's a trade. Somebody is on the other side of that trade. If we win, somebody has to lose. Who's the one that loses? The person writing the mortgage, the banks, or well, these days, no longer the banks, because the banks sell their mortgages to Fannie Mae and Freddie Mac. They repackage these mortgages with a lot of different slices into these mortgage-backed securities. They guarantee the payment and of the principal and the interest rate, which is very important, and we'll come back to that later. And then they sell it on. And these bonds that they sell end up in places like MBB. Now, naturally, the market is a lot bigger than MBB. It's got about 10 billion worth of assets, but it is basically a easy way to check the health of these bonds. Simply put, that's how ETFs work. If you have an ETF, the price of the ETF reflects the price of the underlying. SLV, which we know is a scam, still reflects the silver price because we think there's a lot of silver backing it. PSLV, which we know is not a scam, also follows the silver price because it has a lot of silver. Housing bond ETFs, they follow the prices of the housing bonds. Now, yields and prices are inverted. So if you see a bond drop in price, you can imagine the yield going through the roof. Now, with fixed rate, that doesn't happen. But regardless, the price has to compensate. So, you know, if you've got a 4% fixed rate bond and you've got 8% inflation, well, then the bond isn't worth as much anymore because the 4% that you miss has to come out of the price. So we finally come to MBB. And just to, let's see, here it is, just to show you how it is. You see this little dip here?
Yeah.
That is a global pandemic.
That was
so
COVID.
That is a global pandemic, a total shutdown, lockdown of all economies, and basically Armageddon. This is where we are now. Just for scale. So let me explain this. And it has to do with COVID. What happened in March of 2020 in the panic is that the Fed stepped in to bail out the markets, specifically the credit markets. We all still remember this. LQD got bailed out. HYG got bailed out. Basically, junk debt got backstopped real quick because it was all dying real quick. Now, because the Fed stepped in on junk, AAA had no need to be rescued. Because, well, if the Fed is already buying junk, why would AAA collapse, you know? It makes no sense. Except that it does, if you remember that back in 2008, the rating agencies lied about credit ratings across the board. We've literally seen a movie about it. And if you haven't seen The Big Short yet, you need to watch it tonight, tomorrow. Make time for it. It is extremely important because it's just going to happen again in a slightly different way. So, if we assume that these bonds are in AAA, then that means with these kind of ratings on low-end FICO scores, the bonds are in trouble. And by extension, the ETF is also in trouble, and that is why you see the price crater. Now, the video, when I started talking about it, was here. So when we already reached the COVID low in AAA bonds, it took a while longer, but this date right here, this one's important because you can clearly see, right, that it's still going fairly flat here, and then precisely here drops off a cliff.
Yep.
Well, that is basically the averaged out version of January 3rd on the daily chart. It's more you can better see it. And on January 3rd of this year, the Federal Reserve, for the first time, openly discussed quantitative tightening. And not just quantitative tightening, but faster quantitative tightening and more than previous, which we now know they're going to either start in June or May at $35 billion worth of mortgage bonds a month. You need to understand the scale here. MBB is, I think, one of the biggest MBS ETFs out there. VMBS is another one of about equal size. It's got a market cap of 25 billion and total assets of 10 billion. So if we go by total assets, which is the mortgage-backed securities, which is the Fed's going to sell into the market, the Fed is basically going to sell 3.5 MBBs worth of mortgage-backed securities into the market per month starting in May or June. That is the policy error which bonds are indicating is happening, because the US 3-month did the same thing after the Fed started talking about it, went straight up. Now, there's one more part to the story, obviously, and that is, how can we know what bonds are in MBB? Because if I claim that they're not AAA rated, I have to back up that claim with evidence. All of us have to. We can do this. We can actually look what's inside MBB because it's an ETF. Now, we won't be able to go down to the individual slices, but we can find some information. So I've got the official website open here from iShares. Go away menu. You can see holdings here. Click on it. And you can see here holdings and supplemental information. Now, you can also see detailed holdings, which gives you the CUSIP, how much they have of everything. That doesn't matter. In the holdings, it has the bond name, the name of the bonds. Now, for a lot of bonds, you won't be able to tell what's in it because of the name. It's very generic, and that's part of the problem. But we can find some indirect evidence of the trash that's in there. So let me just click on it. We'll download it, open it, all live. So it's literally their data. And, well, you can see these are the mortgage bonds that are in there in various sizes. Market value, that's like here and here and here. Now, one thing up front, it doesn't matter how big the value is that's in this ETF. What I'm trying to establish here is a pattern of behavior. Simply put, this is a AAA rated ETF. If they put one bond in here that I can prove is not AAA rated, then logically they must be willing to put non-AAA bonds into a AAA rated ETF.
Right.
And if they're willing to do it once, they're willing to do it twice, they're willing to do it a shit ton more. Now, I'm going to show you by hitting Find All. Oh, by looking at FICO. We're looking at the word FICO and then click Find All. Just open up this search results a little bit longer, a little bit bigger. There we go. And you can see a whole bunch of FICO below 660. And below 700.
Didn't they do this back during the last mortgage crisis? They put a bunch of junk in there to move it. Yes.
Now, again, the sizes don't matter because what matters is that if I scroll down a little bit more, you can see here, F Gold 30-year, 3.5% investor, 2016. That tells me nothing about what's in there. That tells me nothing about the FICO scores or the credit valueness of the general bond. So I can't tell you that it's bad, but I also can't tell you that it's good.
Right.
However, what I can tell you is that they threw a bunch of FICO 660 loans into a AAA rated ETF. So I'm inclined to think that when they can actually hide the FICO scores as well, they're more likely to do it and not less likely. And
that's so they can create a secondary market for paper at a rate at which they wouldn't be able to get that paper in the first place, basically,
yes.
Right?
And the reason why they've been able to do this, and this is just an ETF, remember that the market is trillions and trillions in size, so this kind of behavior is endemic, it's systemic, it's everywhere. The reason they've been able to do this is because you've had a buyer of all resort, the Federal Reserve, in the markets for the past, just name how long you want.
They didn't care. They knew they were going to buy it, so you might as well feed as much shit as you wanted to, right?
Yeah, it's not even that they couldn't care. It's that it's not that they didn't care, it's that they couldn't have cared. The amount of QE that they've done since, in March of 2020 and April of 2020, they did $1 trillion, all right? They did $1 trillion per month. I don't know what they bought for $1 trillion, but it was a lot. Ever since then, ever since the $120 billion a month, it was at least $40 billion a month in mortgage-backed securities. That's 4 MBBs, 4 of everything you see here per month. Mm-hmm. Now, I am not aware that the Fed is employing a virtual army of real estate agents that go and check all these properties to see if they're even there.
Yeah.
It's inhumanly impossible to check all those mortgages. If there were just mortgages, it wouldn't even be possible. But they're not mortgages. They're mortgage-backed securities consisting of thousands of slices per mortgage-backed security.
Yeah.
It's insane. It's just too financialized. No human can check it. So
and that's what happened last time is no human could check it. And that's why it eventually collapsed, because they figured out there's a bunch of crap in here.
Yeah. Only now the reason why nobody's noticing this and why only I've noticed it, because, first of all, I don't take any shit. And second of all, it's because, again, junk got bailed out. And we expect this to be junk. So when the Fed started buying the mortgage-backed securities, they bought the worst of the worst, which makes me very anxious to know what's on the federal balance sheet. Because if this is the good stuff they didn't buy and they bought the trash, my God, well, what nuclear waste did they buy? Are those houses even there anymore? It's becoming almost a matter of national security to start auditing the balance sheet of the Federal Reserve. Because if there's still good stuff on there, that's the stuff they need to sell into the market. If they got bad stuff on the balance sheet, doesn't matter. They can print money. They can bail themselves out if they have to. If that's what's needed to not collapse the entire U.S. housing market again in a 2008 style fashion that's worse, then that's what's going to happen. Because you gotta understand the problem now is different from back then. Back then, it was the teaser rates expiring, mortgage rates went up, and people just couldn't pay their mortgage anymore, even though they had 5 houses. This time, it's fixed rate mortgages that are the problem, not adjustables. And that's because the interest rate is going up. So if you're paying 4% on your mortgage and now the entire FICO range is above 4.5%, then you can't refinance. Like, your house prices need to go up considerably to make the difference worth it. Like, if you just get like $10,000 or $20,000 out of your house, but your monthly payments go up with $100 or $200 per month, that's not a good deal. And the higher rates go, the worse this problem gets. Refinancing is done.
So real quick, I want to interject there because
otherwise
over the weekend on the local really popular sports channel, there is a lending show, and I'm not going to name it, but it's in Dallas. Anybody based in Dallas has probably heard this before. And what I've heard the last few weeks is basically in their voice a complete change in the way they're marketing refinances. They're saying, yeah, we know it's going to cost you a little bit more, but if you need to pay off that credit card debt, it's still cheaper. So what they're doing is comparing interest rates between this and credit card. They're still trying to justify people refining to get out of debt and to use your house equity to do it. And that's very dangerous, because if you use a lot of your house equity and the prices come down, you could be upside down on your house, owing a big debt and not being able to get out of it. And I think it's a disservice to people to hear that, but that's what a lot of the mortgage brokers are talking about. They're still trying to get the refis because they're used to living off those commissions. And I think we're in a very dangerous time now where people are going to listen to that and they're going to make the wrong move and it's going to hurt them. Yeah.
So about that, mortgage refinance layoffs. I don't know if it'll bring up recent results. So actually it does. Recently, the news is becoming out that various mortgage refinance companies, well, you can see it here on the screen, have laid off their mortgage staff and refinance staff. And you can see here how prevalent it is. And, well, it basically got started by, I think, Zillow, was it, that laid off a lot of people over Zoom last December. Well, that was, even though it was poorly received, it was the right thing to do because, well, now everyone's doing it, again, because of what's happening in the market. If inflation keeps happening, then everyone's amount that they have to pay goes up per month, and they simply cannot afford as large a mortgage. Now, currently, people are still thinking that the market will continue because housing inventory is at historic lows. I can tell you that the day that inventory starts going up is the day after the top of the bull market. All right? The first day of the bear market is the day after the last day of the bull market. That's just how it works. That inventory can go up real fast if everybody tries to sell at the same time. Now, I'm going to drop an even bigger bomb on you because, well, that's what I found out yesterday. So I've got the first one open. Generally, we don't think it's a good idea if we see the senior executive of a tech company leaving, like 3 or 4 at the same time. We usually think, well, that company is going to go down, right? Because of these mortgage layoffs that I showed, I got the bright idea to start looking at Fannie's SEC filings, not just their monthlies, which we'll do in a moment, because there's a few interesting tidbits in there as well, but to look at their 8K filings, their irregular activities or common activities, whatever it's called. And what I found is pretty shocking. In the last month alone, they lost the chairman of the board, another board member, a CEO, and the chief operations officer.
Oh, people are bailing right and left.
So let me just go down here. It started in October 9th of 2020 when the executive vice president of single-family mortgage business announced that he would retire at the end of the year. Now, let me take a step. Why that's important is because on October 27th of 2020, I made my first bond prediction when I saw the 10-2 rates blowing out. It was then at 60. I said, this is going to blow out in a few days. Turned out to be a few months. Bonds moved glacially slow, but it ended up at 150. So I got that call right, and that's why that lines up there, I believe. Now, the next one is from January 20th, which says, accepted an appointment to become the company's executive vice president and chief risk officer. which is great. I'm happy that they found a new chief risk officer, but that makes me ask, what happened to the old one? You know?
Mm-hmm.
Next up, we have another resignation of the board of directors on March 30th, a year ago, a week after I did my video, actually. Oh, and also of interest is that these mortgage bonds that I looked up for my video in March of last year, a week later in April, 7 of the 10 bonds in MBB got switched out. They were all new. I never published those screenshots, but I still have them. So I just found that suspicious. Now, after March 30th, we get a bit of a jump where nobody left, but that's when everybody started jumping ship. Or, well, not really jumping ship, but, you know, it shows more that they needed people. So 𝙂𝙍𝙊𝙎 became executive vice president and chief financial officer. So the same thing was with the chief risk officer. Why did they need a new chief financial officer?
Right.
And here is James L. Holborn as vice president and controller of the company. Well, Haley was controller, so they need a replacement for it. But he succeeded her as well as Fannie Mae principal accounting officer. So, you know, when you got the same accounting people moving up through the chain, that also makes me feel a bit suspicious. It doesn't have to mean anything, but with everything else combined. So then we come to this year, March 25th, where they lost Kimberly H. Johnson, executive vice president and chief operating officer. So they lost the CEO, the COO. And then on April 7th, they lost the board of directors. Mm-hmm. And since Ms. Blair's gone, they appointed Michael J. Held as board chair. So I think she was the board chair. And at the same time, Anthony Jenkins notified the board of his resignation. So that's another board director gone. He plans to devote more time to his other corporate and civic engagements. But at this point, I think that's an excuse. And at the same time, Fannie Mae's chief executive officer, Hugh R. Frater, notified the company he will resign as CEO. And he's been with them since 2018. Of course, leading the single and multifamily businesses. Also served as the interim head of the single family business from January 2021 to May 2021. These are all people that have deeply intimate knowledge of how Fannie Mae must work. And then here at the end, I've included, as Twitter doesn't allow me to zoom in, great. This basically says the single family delinquency rate is going up because people are exiting for forbearance and they're entering their 19-day trial period. Now, they expect everyone who exits a forbearance to come out of that trial period properly, but this was at the start of this year. This is basically like there's the Q4 and full year results. So now that inflation's going up so much, I'm not sure that anybody in forbearance can actually meet those payments. I'm not entirely sure that they are sure. So that is noticeable that Fannie Mae executives are jumping ship. And just to go to their monthly summaries, not monthly, monthly. So what's noticeable here is two things. I'll take the latest in February, but also the first one that I can find in 2010. This was the one that goes back to January 2009. So this is after the financial crisis and the housing crisis. One thing that's different between Fannie then and Fannie now is that back then they had a mortgage portfolio balance of nearly 800 billion. That is by now down to below 100 billion. They also had a lot of debt, almost 800 billion in debt. That is also down to down to 180 billion dollars in debt. So that is what they've been doing in conservatorship over the past decade. However, that is not the number I want people to look at. Also, not the delinquency rates or the default rates. It's all not really important. What's important here is this number, the total book of business. So what does Fannie Mae really do? They buy mortgages from the banks, from houses that have been built and financed. They guarantee the principal and the interest rate payments. They slice it up, put it in these mortgage-backed securities, and sell them on to investors. That is their guarantees. So obviously with guarantees that if these things go bankrupt, they're on the hook for it. And since they're still under conservatorship, I would say that means the US taxpayer is more or less on the hook for it.
Yep.
So this is the old one. Let's go to the latest one. You can see here, this is 3.2 trillion with a T. This is 4 trillion. So while Fannie has, you can see here, gotten rid of their own mortgages as well as paid down their own debt with the money that gave, their actual guarantee business has grown with 800 billion by itself. Now, I'm not going to look up Freddie, but I already did. And since 2013, this number for Freddie has doubled from 1.5 trillion to 3 trillion. So there's now about $7 trillion between Fannie and Freddie of guaranteed mortgage-backed securities that are all rated to be, well, whatever they're not. And it gets even worse because this line started appearing since July 2019, so before the pandemic. And it says Fannie Mae's maximum exposure to Freddie Mac collateral that was included in outstanding Fannie Mae securitizations was 229.2 billion. You add what's on the statement of Freddie to that, and you come to $337 billion worth of cross-collateral contamination. What that means is that if this Fannie Mae loan goes bad, and it's a re-securitization from Freddie, then necessarily the Freddie loan also is going bad. So there's at least $337 billion worth of loans that are on both their balance sheets, which if they go bad on either one's balance sheet, they go bad on both their balance sheets. Which is not a good thing.
So just to reframe what we have some cross-collateralized debt that could affect both parties. We also have a lot of debt on there that's not what it seems. And the market has started to realize that, at least in terms of the valuation of an ETF. But the broader public has no damn clue that a lot of what's being included in these really high-quality mortgage-backed securities is not high quality, and it's a replay of what we saw in 2007, 2008. So
only now it's bigger.
But it's bigger. Yeah, it's blown up, of course. Kick the can down the road, everything's bigger. So the question I have for you is we end up this part of the interview, and we'll get into some other stuff later. As far as mortgage-backed securities go, what does this mean to the average person? What's the risk?
You're fucked.
Yeah. Okay.
Doesn't matter what, if you have a mortgage, if you don't have a mortgage, we remember 2008. Only now it's bigger.
Yep.
Now, technically, it doesn't have to be bigger because of I have no idea how big the derivatives market is. If you've seen The Big Short, CDOs, synthetic CDOs, let's hope to God that entire market has shrunk since then. But The Big Short also ends with a so-called bespoke tranche opportunity, which is just another name for a CDO. And that was 2015. I have no faith that they've fixed anything, considering that it's so easy for me to find out that they haven't fixed anything. It's already happened. I'm not even making a prediction. You can see the line on the freaking chart go down. Look at this. This is 2007. This is Lehman Brothers. We are here. And it's not just that we're here. This is a speedy decline. And so to make matters even worse, it's not just retail. It's the corporate mortgage-backed security market as well, except that made a new all-time low before MBB did. So the corporate mortgage-backed market is also fucked. I've looked at what's in CMBS, just like I just did with MBB. None of the names say anything relevant to the FICO scores. And to make it even worse, there is Fannie and Freddie stuff in there, but there's also JP Morgan stuff in there, which is a lot harder to find out what the fuck's in there. So, oof.
So, yeah. Deso's been covering this. He covers it on Twitter. If you follow him on Twitter, he'll cover this. He'll do videos.
Among other subjects.
Yeah, among other subjects. You cover a lot of stuff. I think what I'm going to do is we're going to take this piece and publish it separate. So we'll do what I usually do at the ending of a video is say, how do people follow you? How do they get this information?
So they can find this information among a lot of other things on Twitter where I'm most active. If I find something to talk about that is long enough and I haven't seen anybody else talk about, I'll write an article on my Substack, desogames.substack.com. I've got some older articles on desogames.com. And you can find me and ask me questions directly on Twitch. I stream on Twitch every Thursday and Saturday. That's also twitch.tv/Deso Games.
All right. Thank you, Deso. We'll have you back on. We're going to talk about the Russia gold situation, the ruble gold situation. Stay tuned for a follow-up interview on that. Deso has some very interesting information there that I don't think is well known, but may change your view on how that may affect the gold market. We'll come back to that. Thanks, Deso, for joining the program.
My pleasure.